For today's interaction, I'm joined by my colleague Chirag, and we have with us Dinesh Balachandran, Head of Equity at SBI Mutual Fund. Welcome, Dinesh.
Thank you, Ruchira. Glad to be here.
Great. Now, let's begin with, with your impressive background from IIT Bombay and MIT to achieving a CFA. What initially sparked your interest in the financial markets?
That's a very interesting question. So when I joined IIT Bombay, obviously finance was probably the last in my sort of like view of what I would be doing. I was definitely a lot more focused on engineering and doing something related to that. So it is with that mindset that I moved to MIT. So in MIT, again, the thought process was that I would do my PhD and do something such. But then what happened was that the nice part about MIT is it's quite open, which means that you can go to any department and attend any class. There are no barriers for sure, right? So just out of curiosity, I happened to take a few investing related classes at MIT Sloan, just to get a sense of what is this field all about. And while it was just a few classes, something really clicked for me. The one fundamental problem with a PhD-like experience is that you can go for years trying to do something and not know whether you're going in the right direction or not. So the feedback loop in terms of timing tends to be very long. But in investing, it feels like the market gives you a report card all the time. Sometimes maybe it's too much in terms of feedback loop. But the fact remains that the market always sort of like tells you whether you're doing well or not doing well. And the puzzle sort of aspect of it, because no one has really cracked the code, right? Everybody tries to go about it in a certain manner, but there is no one right solution when it comes to investing. So the intellectual challenge associated with that sort of appealed to me quite a bit. So then I decided that, let me at least give it a shot. If it doesn't work out, then maybe I'll just go back to my basic roots. But thankfully, it has worked out so far for me.
Dinesh, I'm really curious about your transition from a decade in a fixed income management at Fidelity in Boston to focusing on equity markets back in India. What motivated this significant shift in your career?
Yeah. So at Fidelity, I was glad, I was sort of happy about the fact that I got to sort of cover all the various subsectors. So while at Fidelity, I covered everything starting from money markets, municipal bonds, taxable bonds, corporates, structured finance, the CDO space, all that stuff, right? So it felt like I practically covered almost all the major aspects of the fixed income market while I was there. And when I moved back to India for personal reasons, I was looking for some sort of change, something again new that I can essentially challenge myself with. And the one primary difference between equities and fixed income is that when you think about it from a risk-reward perspective, the risk-reward ratio obviously is much more magnified when it comes to equities. So then there is a very distinct challenge associated with that, right? That if you go right, you can essentially sort of make a lot more money. And the downside also often in equities tends to be much higher. So from that perspective, it felt like it's like another level of challenge for me. And it is something that I really wanted to sort of like try out. And so that's what essentially sparked my desire to move from fixed income to equities.
Over your 12 years at SBI Funds Management, transitioning from senior credit analyst to head of equity, what key lessons have shaped your approach in your current role, if you could tell us that?
I mean, there are so many lessons actually. When I think about like certain basic sort of takeaways that I've had, one is clearly the importance of teamwork. Because when you talk about circle of competence, no matter how good someone might be or how smart someone might be, each person has a limited circle of competence. So when you are essentially talking about, for example, managing a diversified portfolio, you have to lean on others. You can't do it all yourself. And so this idea of having a good team around you, where you rely on others for ideas, you rely on others to even just act as a sounding board. I think that is something that's a very important and maybe slightly underappreciated trait. So for me, having a good team and having good team members essentially around me, I think is something that I really have cherished here at SBI Mutual Fund, and I think it's very important for any good organization. Essentially. Two, when you think about the psychology of investing, it's so easy to get carried away with the sentiments of the market, right? At any given point in time, the market might be so enamored with certain factors. And it's sometimes difficult to sort of stand out from the crowd. It's quite difficult to sort of stay away from where the action is. But I think it is also a very important trait needed to be successful because most of the major returns, in my opinion, comes from having a differentiated view. And to have the differentiated view, one, you have to have the right temperament where you're willing to sort of go against the crowd or at least sort of think in a different manner. And two, you obviously have to do the research that gives you the conviction to stay away from the crowd. So from that perspective, doing basic research well so that you develop strong views and then having the temperament to sort of act on it. And if necessary, just go completely away from what others are doing. I think those are sort of very important factors, and those are lessons that I've learned.
Right, Dinesh. How does your extensive background in fixed income shape your strategies in managing equity portfolios today, especially if you look at the concerning the risk management or the asset allocation thing?
Yeah, I think when I think about equity investing, a lot of it is bottom up. Where you sort of do company by company analytics of business models and so on. But I think there is also an important top-down component that comes in. Particularly when you talk about cyclical sectors, you have to have a good understanding of macroeconomics. You have to have a good understanding of various sectoral cycles. So there, the fixed income background has definitely helped me. So when you think about, for example, inflation or lack thereof, which sectors really benefit in an inflationary environment, which sectors lose out in an inflationary environment, and vice versa. Those are important factors in decision making. And if you have a good sense of macroeconomics, I definitely think it gives you a leg up. So to me, the top-down part of equity investing, having a fixed income background has definitely helped me there.
All right. Now, in the previous answer, you mentioned teamwork. So coming to that, co-managing SBI Balanced Advantage Fund and, the SBI Multi-Asset Allocation Fund entails collaboration with your debt-focused colleagues. So have there been instances of disagreement with them? And if so, how do you navigate such situations?
Disagreements is too strong a word.
Mm-hmm.
But have there been occasions where I've had difference in opinion with them in terms of partly because I also have a fixed income background, so I have strong views even with respect to fixed income. I will often challenge my fixed income colleagues and question in terms of why they are doing what they are doing. But at the end of the day, what is also very clear is each of us has a very defined set of responsibilities, which means that at the end of the day, the fixed income portfolio has to be managed by the fixed income manager. So while I might needle them and I might just sort of act as devil's advocate occasionally, even I realize that at the end of the day, the buck stops with them. So it's just that I've seen that in investing, it's often good to have a devil's advocate, someone who constantly questions you, who constantly prods you in terms of whether you're doing the right thing. And so I try to do that occasionally. And so from that perspective, it has never led to a bad atmosphere per se. I think there is a very good collegiate atmosphere here. But difference in opinion, it happens all the time. And that's really part and parcel of the process.
Dinesh, could you please describe your investment philosophy and strategy, and what type of stocks or market situation excites you?
That's a very interesting question. In terms of investment philosophy, internally, we are always sort of fond of saying that sometimes this value versus growth, it becomes like a superficial debate. Because at the end of the day, we're all essentially trying to do the same thing, which is that we are trying to get the best possible company with highest growth prospects and quality at the lowest possible valuation, right? that is how you make like very good returns. But the problem is, unless and until you're talking about a COVID-like scenario where everything became like so cheap, normally you don't get all three of them lined up at the same time, right? If the market recognizes a certain company as being of high quality and with good growth prospects, you're not going to get cheap valuations, and that is where I have to essentially compromise somewhere. Now, certain people say that they don't want to compromise on the quality part even a little bit, and so from that perspective, they are okay overpaying, so to speak, for that company. There, I am probably at the other end of the spectrum, where I say that for me, valuation is a very important component of margin of safety. Now, when I make that statement, does that mean that I just go for any cheap company without any regard to quality profile? No, absolutely. Obviously, I'm going to have a basic set of quality filters, basic set of business model filters, and so on. But I'm always going to sort of focus probably more on valuation than some of my peers. And from that perspective, people categorize me in the value bucket. That I sort of belong to the value investing philosophy. But the basic point I'm trying to make is, at the end of the day, you want the highest possible growth, quality growth at the lowest possible valuation. And that is what we are essentially trying to do.
And what kind of markets and situations excites you?
Yeah. No, obviously, when you think about the contrarian part of me, right, which is the other aspect, where I actually, thankfully, have no qualms, sort of like moving away from the crowd. That is something that I think I'm inherently very comfortable with. So a market where there is a lot of fear, there is a lot of pessimism, inherently excites me because I know that then there are a lot more opportunities in such markets, right? So from that perspective, when you have an economy just coming out of a long downtrend and about to embark on a growth uptrend or embark on a new growth upcycle, right? That's the perfect situation for me, because what will happen is that most people will be backward looking, and so they will be avoiding a huge swath of the market, while I can afford to sort of maybe think a bit different and think about what can happen going forward. And so from that perspective, the opportunity set for me will be like pretty good. The opposite of such a market, which is basically one where everybody is excited about everything and everything is flying off the shelves and valuations are very high, sort of where we are at this point in the market today. This is probably the toughest market for me, because to try to get something with a high margin of safety, it's become extremely challenging. So this would be the kind of market that is the most difficult for someone like me.
All right, now moving on, what criteria make a stock a compelling buy for you? If it's possible for you to cite some anecdotes there, that would be great.
So what I've realized is this, right? When we talk about margin of safety, margin of safety can come from multiple dimensions. Mm-hmm. One dimension is valuation, the other is from a quality of business model and so on, right? For me, what I try to do is essentially I have normally few valuation yardsticks. Now, for different companies, the yardstick will be different. So I'm not going to put every company on the same level and say that every single company should trade at the same valuation, right? So I will have different yardsticks for different types of business models. So that is one criteria that I have. The second criteria is in terms of the quality of the business model. I try to eliminate all companies that have severe terminal value questions, because there it can be like a melting ice cube kind of thing where you are worried that yes, there is value today, but the company might not even exist 5-10 years from now, right? So you try to eliminate those kind of companies. You try to eliminate companies with questionable corporate governance, because this is another lesson that I've learned over time, that this value is an ephemeral concept. In the hands of the wrong person, you are never going to be able to monetize that. So from that perspective, you try to eliminate companies with questionable corporate governance, and then try to see whether there are companies that have minimum quality criteria, minimum sort of like business model robustness and so on. And there you're then trying to find out, is the market overlooking something that's sort of like really positive at the margin. To give specific examples, think about a name like Tata Motors, right? Now, Tata Motors, and I can even add M&M to this list. Both these companies had certain strong core competencies, which means that there were certain aspects of their business which was always good, which was always considered good by not just me, but by most people in the market. But both companies went through a tough phase where certain other parts of their business, be it capital allocation or be it unrelated diversification and so on, they came together to drag these companies down. Now, when new management comes in, what happens is that they don't have any legacy issues, legacy baggage to deal with, so they can start with a clean slate. And so in both of these companies, what we saw was that as new management team came in, the capital allocation was the number one thing that they fixed, where they said that, no sort of like unrelated sort of diversification. Capital allocation problem fixed. They then decided to sort of focus only on certain segments where they are strong and not to be like, one size fits all kind of thing. And so in both in Tata Motors as well as in Mahindra & Mahindra, for example, it initially wanted to do everything: entry level sedan, luxury sedan, SUV, farm equipment, and so on. Right? Then they realized that they have no business to be in the entry level space. So when the new management came in, they decided to sort of let go of that segment. And this is when like good things happen. When you have and in both these companies, corporate governance was never really a concern per se. Right? You never had an issue with the promoters per se. So that also allows you to be a bit more confident. So when then you have this nice combination of much better capital allocation, a more focused management team, and at the same time, the macroeconomics also was suggesting that a strong auto upcycle is likely upon us based on historical trends and so on. Then you get this very nice trifecta of strong sectoral tailwinds, very positive things happening at the company level. And because these stocks were such big laggards over the previous decade, the valuations had become very, very reasonable. So for me, that is like the kind of stock that I would want to go for, where I can sort of see a very nice combination of a strong earnings upcycle. And if I'm right in my thesis, valuation multiple will also add to that. So the combination of that can lead to very strong excess returns. This is something that we've seen in autos. This is something that we've seen in financial services as well. Because when you think about, for example, a name like ICICI Bank, right now it is probably the most consensus stock. If you take a look at like 50 different portfolios, I think 49 will probably have ICICI in the top 5, right? But 7 years ago, this was not the case. 7 years ago, most portfolios did not want to own ICICI Bank. But for me, it was always a case of a company which always had one strong core competency, which was a strong liability franchise. The problem was only on the asset side. And the problem was with the previous management. Again, when you have new management coming in, who doesn't have to worry about legacy baggage kind of issues, and you essentially also have a sectoral tailwind coming your way in the form of overall NPA issues getting resolved thanks to IBC and just the general upcycle at the sector level or economy level, you again get a very nice combination of strong profit growth. And as the market gains confidence in that, the valuation multiple also gets re-rated. So I can go across sectors, but you will see some sort of common themes emerging in terms of the type of companies that I would want to essentially go for.
All right. As a manager of Contra Funds, where do you currently see contrarian opportunities in the market?
Yeah, maybe cash, I guess. I mean, right now, honestly, it's very difficult to find great value in the market. This partially explains why I have a very high cash level in the fund, because I'm finding it very difficult to sort of deploy for the kind of return expectation that I have in place. So what is happening now is if you are looking for a high teens, close to 20% type return CAGR, it's becoming extremely challenging to find stocks where you also want to think about, corporate governance and basic business model governance and so on, right? So it's honestly it's very challenging to find great bets. A few months ago, we still felt that energy was probably the last sort of overlooked sector, so to speak, where we could still find sort of good value opportunities. In fact, that was the main reason why we decided to launch the Energy Opportunities Fund as well, because it felt like this is the one area where you can easily say that, without making any heroic assumptions, I can easily see pretty good returns across a variety of stocks. But even there, now a lot of these stocks have gotten re-rated significantly. And while they still look attractive, are they like as much of a slam dunk opportunity as they were like 6 months ago or 9 months ago? The answer is no. And so from that perspective, at this point, I have to just deal with slim pickings in the market. There are no great opportunities, at least in my view, essentially.
It seems, looking at the portfolio, you are favoring energy sector as of now, energy, metals and minings. If you look at the portfolio of SBI, Contra and the long-term equity portfolios, while being underweight on the banks. So what drives this sector preference at this point of time?
Yeah. So this is where the top-down aspect for me comes into play. I have this basic thesis that just like last decade, from a macroeconomic perspective, the single biggest driving force was lack of inflation, disinflation or deflation. Essentially, it was the single biggest sort of driving force across countries, not just India, but across the world. And this is what led to interest rates finally going to ultra low levels, because people felt that inflation is not at all a problem. But just like everything else in the markets and in the economy, these things tend to be cyclical in nature. So what has happened is that after a decade-long lull in inflation, I think now inflation is coming back with a bang. And from that perspective, hard assets, which were sort of completely frowned upon in the last decade, I think they are now becoming a lot more attractive. So in any sector, when you had a decade-long sort of underinvestment type profile, pricing power slowly comes back to the remaining companies in that space. Now, 5 years ago, if someone had told you that they are going to set up a new mining project or set up a new thermal power project, they would have been laughed out of the room. Nobody wanted any company to do anything like that. And that has led to essentially severe underinvestment in a lot of these sectors. And now, the guys who have these assets in place, they are now getting their pricing power. And because last decade was so bad for companies or stocks in these sectors, many people from a backward-looking perspective are still shying away from them. They still feel that inflation is just a transitory thing and it will sort of go away pretty soon. And the moment war goes away or whatever, they think inflation will no longer be a problem. I beg to differ. I think this is going to be a decade-long issue. And from that perspective, in fact, as the decade progresses, as more economies gain momentum, the profile or the earnings profile for a lot of these companies is going to look even better. And from that perspective, these, like on a relative basis, these are the sectors that I would want to bet on, where they've also gone up. It's not as if these sectors have been completely left in the dust at this point. That was the case 2 years ago or 3 years ago. They've also gotten re-rated. But in the grand scheme of things, can I still see good returns coming from stocks in these sectors? The answer is yes. And the underlying thought process is one of inflation becoming a much bigger issue this decade. And owner of hard assets will have good times going forward.
Could you explain a little bit more what is the relation of inflation and the owner of the hard assets kind of thing?
Yeah. So when you think about it, think of land as in fact the best example, right? Now let's assume I own land that is valued at 100 rupees. Now, if inflation is not at all an issue, now land by itself doesn't really generate any cash flows, right? So from that perspective, land, gold, they're like similar assets in that the asset itself doesn't really generate huge cash flows. But it is one where the value of that land is based on your view on what inflation is likely to be down the line. Because the supply of these assets is limited, which means that if I believe that inflation is going to be at a much higher rate going forward, all else being equal, the nominal value of these kind of hard assets inherently will go. So last decade, for example, gold, real estate didn't do well at all because people believe that prices are not going to change much at all. Inflation is what? It's basically the prices of goods and services, right? If you have the general belief that the price of everything is going to remain the same 1 year down the line, 2 years down the line, then the nominal value of the price of these assets is not going to change much. The moment you start thinking that inflation is going to be a big deal, which means that price of something today is going to be lower than the price a year down the line or 2 years down the line, then that is going to percolate down the spectrum. And immediately the nominal value of these kind of assets will go up. So it's no surprise to me that real estate also is doing well, that people inherently are saying that prices are going to go up going forward. And so from that perspective, they want to lock it in before prices go up further.
Dinesh, for first-time investors who want to invest at this point of time, would you recommend starting with a hybrid funds or a diversified equity funds in the current market scenario?
I would definitely encourage people to start with hybrid funds, because what happens is that equities represent one of the best ways to generate wealth from a longer term perspective. There is no doubt about that. And so from that perspective, one should always argue for equity funds. But the point is that no matter what people say in terms of the time horizon, I hear this all the time. People say that my horizon is 10 years, 15 years. The moment they see a 15%, 20% correction, they are thinking like, get me out. And that is because, you can't wish away the volatility that happens in equity markets. You are going to have your garden variety 10% corrections. Once in a while, you're going to have these more severe 20% plus corrections. It's just how it is. Now, for a first-time investor, often this can be quite shocking to see your portfolio down by 15% in a matter of 3-4 months. And it has happened. And it will happen going forward also, because that's just how it works. So then it's better for them to slowly get acquainted with how capital markets works. And that is where hybrid funds is a very nice part of the solution, where by giving a combination of equity, fixed income, or in the case of multi-asset, you're also talking about commodities, you are essentially getting to a much lower sort of risk profile. And that then allows the investor to feel more safe. And as they then become more comfortable with equities, where they see that, yeah, I saw a correction, but you know what, it didn't really matter once I went past a 3-year horizon or some medium-term horizon, then that person will automatically feel more comfortable putting money to a pure equity fund. So for me, doing it step by step really sort of makes a lot of sense for most first-time investors.
And which particular in the hybrid category they should look after?
To the extent, as I said, I have this belief that inflation, and more importantly, inflation expectations, is going to be a sort of a sticking point. Is going to be in the front of people's minds for at least the next several years. I think the argument to have a hybrid portfolio which also has precious metals / commodities is quite strong. And so from that perspective, I would actually, be in favor of a multi-asset allocation fund, where you have equities, which inherently offers you the growth opportunity that's there in any economy, fixed income, which definitely provides benefits from a recession that happens once in a while. So the fixed income definitely helps from that perspective, and also the stable income that you get in fixed income, that also adds to the benefit. And precious metals / commodities takes care of the stagflationary scenario, where we are talking about an economy that is not going to grow that fast, but still has inflation issues to worry about. In such an economy, something like gold does really well. And to the extent, I believe that unlike last decade, where stagflation was the one thing that no one had to worry about, I think this decade, it's probably going to be a concept that will become more familiar to many investors. And from that perspective, having this third asset class will definitely help most investors.
Before we wrap up this chat, last question. Looking back at your career, what has been the most surprising market trend or event you've encountered, and how has it influenced your approach to investing?
Yeah, so in fixed income space, there are these models that you build where you try to forecast interest rates going forward, right? And most models used to have zero as the lower bound, because the thought process was that how can interest rates go below zero? Why would you essentially give money someone with the clear expectation that you're going to get less down the line? And so for me, like a 0% interest rate, it felt like a perfect sort of lower bound. But then what we saw towards the end of the last decade in certain advanced the Western world economies, where you had negative interest rates going out to the 5-year, 10-year point of the curve. That's something that I never thought was going to happen, but it happened, right? And from that perspective, it told me that we take a lot of things for granted, but you never know when you think about these sort of, as they call these black swan events or whatever, events that you're not at all prepared for. They happen a lot more than you think, and so from that perspective, you have to stay humble and you have to stay grounded, and you have to always go with the assumption that you don't know everything. So you think about future from a probabilistic perspective rather than a definitive perspective where you say that I know this is going to happen. You talk about probabilities. You say that this is more likely to happen and stuff like that. So that the negative interest rates, the negative crude oil prices that we saw post-COVID, those were all sort of like big surprises that I never thought will happen, but they've happened over the last.
Well, Dinesh, thanks a ton for spending time with us and diving deep into these questions. It's been great having you.
Great. Thank you, guys. Thanks a lot.